So you want to get started with investing. You might have some extra cash lying around and you're thinking you should do something with it. You could buy some crypto or an NFT, maybe that new watch you've been thinking about, or some fine art. You could buy some stocks, government bonds. The list goes on and on. And there's the fear that you could lose all your cash if you make the wrong choice. So this video is the ultimate guide to investing for beginners. We're going to break it down into 5 easy parts. Part 1, what's the point of investing? Part 2, what's a good investment for beginners? Part 3, when and how to invest? Part 4, some common concerns you might have as a beginner? And Part 5, some alternate strategies. Let's start with Part 1. What's the point of investing? Well, investing helps your money earn more money. Rather than trading your time for money, investing means that your money is working for you. That is the magic of compound interest. Even Albert Einstein said that compound interest is the 8th wonder of the world. And let's not forget this important part of the quote, which is, he who understands it earns it, and he who doesn't pays it. Compound interest is the math secret behind wealth creation. If you take $1,000 a month and invest it at a 10% return, in just over 6 years, that $1,000 will be worth $100,000. But here is the crazy part. In just less than 4 years, you'll have another $100,000. And the next $100,000 takes less than 3 years. And the next, less than 2 years. And so on until you have $1 million. That's why investing early and often is the key to getting ahead. Second, investing helps you stay ahead of inflation. Let's say you have $1,000 lying around. What should you do with it? Should you save it for a rainy day in a piggy bank? Buy that fun new gadget you've been thinking about? Or leave it in your savings account? Here's the thing. Inflation is eating your cash. That $1,000 won't be worth as much in a few years as it is today. The prices increase and your buying power decreases. Think about it. That loaf of bread you used to buy that costed $2 now costs $3 or $4. That's inflation at work. So the best thing you can do is invest to outpace inflation. Part 2, what to invest in as a beginner. So the next big question is, what do you actually invest in? There are several types of investment called asset classes, most of which you buy in hopes that one day you can sell them for more. You have stocks, shares, and equities, which are kind of the same thing. You have real estate, watches, fine art, crypto, NFTs, bonds. Each of these asset classes come with their own risk, so for this video, we'll be sticking with stocks and shares. Stocks and shares are one of the more accessible investments. They don't come with crazy risk like crypto, and you don't have to have a huge sum of money like you do with real estate. When most people talk about buying stocks, they say, I want to buy some Tesla, or I'm going to buy some Nvidia shares. What you're buying in stocks and shares is a percentage ownership of the company. Let's say you wanted to buy some Microsoft shares. Microsoft is a publicly traded company. That means you, the public, can trade Microsoft shares. You can't buy shares directly from the company. You need to go through a middleman called a broker. But once you have gone through this broker, you are now a partial owner of Microsoft. But how are you supposed to choose what company to buy into? One of the biggest mistakes that beginner investors made, and let me tell you, I've made it before, is to buy whatever is hot and trending right now. Let me tell you, this is a bad idea. In financial marketing, we have to say this phrase, which is, past results aren't indicative of future performance, meaning that just because a stock did well in the past doesn't mean it's going to continue to do well in the future. Morningstar wrote an article of the top 15 wealth-destroying stocks. Each of these stocks were top stocks at the time that they were bought into, but ultimately, all of them lost their investors' money. So how can you build a stock portfolio with less risk? The answer is index funds. Index funds allow you to buy a small piece of many different companies. This strategy is less risky because it increases your chance of being able to both retain and grow your wealth. Warren Buffett, one of the best investors of our time, said that the average person won't know enough to pick stocks, but they don't have to because they can buy an index fund. Realistically, the average person isn't going to have enough information to pick stocks well. Even financial analysts, whose job it is to make these decisions, choose incorrectly some of the time. So what you should consider investing in for lower risk is an index fund. Quickly, as an aside, I'm not a financial planner, this is not financial advice, and you should do your own research before investing in this or any asset class. The simplest way to understand index funds is to break down the words index and fund. An index is a list of companies, so the S&P 500 index is the list of the top 500 US companies, and a fund is a pool of money from investment contributions that invests in the index. The strength of index funds is that buying one share is getting you a piece in hundreds of companies. This lowers risk because one share doing badly, one company doing badly, is not going to have a big impact on your portfolio. It's also diversified because your one share is betting on many different industries going well. The S&P 500 index has exposure to tech, energy, healthcare, consumer goods, and mining. Let's look at one of my favorite index funds, VOO or VOO. You can see that VOO owns Nvidia, Google, Berkshire Hathaway, which is Warren Buffett's company, Coca-Cola, FedEx, and these are just some of the recognizable companies on the list. VOO holds a different percentage of each company based on market cap or how valuable the company is. VOO and other funds tracking the S&P 500 index are designed to let investors like you and me buy into the benchmark of the US economy. So if the price of VOO goes up, that means most of the companies in the index are increasing. During a time like COVID, when the price went down, we all collectively agreed that the companies were worth less than they used to be, which lowered the price. More on that later. So what does this mean for you? If you bought $1,000 of VOO, you're getting a certain amount of Nvidia shares, a certain amount of Google shares, a certain amount of FedEx shares. Your portfolio is automatically diversified. What's the alternative? Well, you could pick stocks on your own. You could say, the S&P 500 sounds good, but I want to try investing for myself. The chances are you're not going to outperform the market consistently. You have 3 hours on a Sunday. The skill to know how to buy and sell stocks and when and how much to buy takes years to build. Without it, even if you bought exactly the same amount of each stock that was in a fund, you'd still have to be constantly tracking the market to figure out when to buy and sell. And at that point, isn't it better to just buy into an index fund? Realistically, even fund managers who have all the time and resources in the world still struggle to beat the market. And even if a fund manager can beat the market, the chances are that they continue to do so year after year are slim. Data shows that US funds struggle to beat the market 90% of the time year over year. This figure rises to 95% for Canadian funds and sits around 85% for Australian funds. Index funds exist so that you can try to mimic the market rather than compete with it. The market is comprised of all companies in a country. The top 500 companies in the US are competing tooth and nail against each other for the attention and money of their consumers. That's thousands of people with the single goal of beating out the competition for their customers' dollar. The market reflects the millions of transaction decisions made every day. That's why it's so hard to beat. You have to know what people are going to do before they do it. You have to consistently buy in and sell out before they start and stop. And you have to choose the same companies consumers are going to choose to fulfill their needs before they've even chosen. This brings us to part 3, how to invest. So now you're thinking, okay, I want to buy an S&P 500 tracked index funds, but how do I do that? Well, this is where those online broker accounts come in. This is going to vary from country to country, so to find out what works best for your country, you can Google that. I used eToro when I was in Australia. Some of my American friends use Robinhood, and now I use Wealthsimple in Canada. I have a list of online brokerages that I update from time to time. You can access that in the description, or you can just Google it to find what's best for your country and circumstances. I will say that investing can be a bit scary when you start off. The fear of potentially losing your funds can really stop you from kind of going that extra mile. MarketWatch has a game which lets you simulate investing with fake money in real markets in real time. I've created a game for my community. It's free to sign up and to use, and this is not sponsored at all. I just think it's a really good way to get comfortable with trading, and I like to provide that for my community. Part 4, common fears and questions. So you're probably thinking about investing and maybe worried about losing all your money. You might be thinking, what if it goes to zero? Or what if all the money that I put in just crashes overnight and I have nothing? By investing in index funds, you're unlikely to have this problem because it's so diversified. All 500 companies would need to collapse, or a large majority of them, to have any effect on your portfolio. You will lose money if the value of the company decreases, however. Let's say you bought into an S&P 500 index at the end of 2019. By the start of 2020, around March, you would have lost about a third of the value of your portfolio. If you sold then, you would have realized that loss and actually lost money. If you didn't sell and you held your portfolio, look at the years since. The market has recovered. Your initial investment would have over doubled by now. If you resist the urge to sell and hold your funds, this is where the real value can be made. Your wealth would have profited over COVID. The longer you leave your money in index funds, the more you can expect your wealth to grow. When you're investing in index funds, you're investing in the whole economy growing. Another common question is, how much should I start with? It kind of depends on you and the platform that you use. Some allow you to start with as little as $1, others have $10 or $100 minimums. Check out the rules of the platform that you use in the country that you're in. Wealthsimple, for example, allows you to start with as little as you like. I recommend investing early and often, maybe once a month, but again, this is not financial advice and I'm not a financial advisor. If you've enjoyed this video so far, let me know what's your biggest concern about investing. What's holding you back? Let me know in the comments. That brings us to part 5, which is alternative investments. I like Alex Hormozi's way of thinking about this, which is there's nothing more valuable to invest in than yourself. If you put 15% of your income into the stock market every month, then by the time you retire, you could be a millionaire. But you could probably get there much sooner by investing in a skill that makes you more valuable to your employer or makes it more likely that you can start a profitable business. The whole way through making this video, I kept coming back to this thought in my head, which is it's way more likely that you can make money if you invest in yourself, because the potential upside of investing in yourself is so much higher than the stock market can give you. The S&P 500 can give you 6 to 10% return year over year, 12 some years, but investing in yourself can give you 50, 100 times return on investment in that same time. You could start an online store or own a coffee shop. You could build a business on YouTube or start consulting in something you're already an expert in. Building, owning, and growing your own business is much more likely to make you wealth than investing in any marketplace. Although some businesses fail and it does require a significant level of effort and skill, unlike investing in the market, which is quite passive. Investing in yourself, your skills, your value, increasing your productivity is an alternative worth considering. Thank you for watching today, and check out my other videos here or here on the screen. Thanks for watching and hope to see you next time. Bye!